Hello and welcome. You're watching The Money Show with me, Kavita Thapliyal. And let's begin the first topic of the day. Credit card. Credit card spends touched an all-time high of rupees 1.37 trillion in March 2023, the latest Reserve Bank of India data showed. And it's for the 13th consecutive month that credit card spends have topped rupees 1 trillion mark, reflecting the increase in consumer spending since the easing of COVID pandemic. Now, let's understand this in more detail with Aparna Ramachandra, founder director, rectifycredit.com, Ritesh Srivastava, founder and CEO, Freed, and Anil Pinapala, founder and CEO of Vivifi, India Finance. Good evening and welcome to the show. Aparna, let me begin with you because every time we have a discussion, this is something that you always talk about, saying that this is going to be a very crucial data to analyze if at all credit card spends or the personal loan borrowing hits all-time high, which I can clearly see happening. So if we look at the data, Aparna, FY 22-23 credit card spendings have topped to 14 trillion, which is up 47.2% as compared to 9.71 trillion in FY 22. What is the kind of indication that you're getting after looking at this data?
Hi, Kavita. At the outset, this is extremely scary. This really scares the daylight out of me because this kind of credit card spend is really huge. And if you further see in that study that they have come up with, of this, 63% of the spend is online spending. So, which means there is lot of, usually what we see is when people buy online, not everything is what you right away need. Sometimes you buy because something is on offer. Sometimes you buy expecting that you might need it later, and all kinds. So these are all not actually complete necessary spendings, if I can stick my neck out and say that. So this is a very, very scary, you know, direction that we are heading. And in this, what my bigger fear is, I only hope somebody comes with that data. Of this 1 this trillion that spend that has happened, I don't know how many of them have actually paid back all their credit card dues on time. How many of them have converted it into EMIs because they are not able to pay the whole bill on time? So these are all data points which our regulators and other deciding partners in the ecosystem need to look at. Otherwise, we are heading for a major bubble burst. And like I always tell you on this show, it is these personal loans, these BNPLs, these credit card spendings which are not good. And this is not any COVID pent up demand, or this is not any spending on the necessities or buying of an asset or whatever. Credit card spending is not really asset buying spend. So this is a very scary path we are heading for.
Exactly. Anil, it is not only the credit card spends that have hit an all-time high. Even the credit card customer base of different banks have gone up, and they've gone very high for most of these private sector banks also, if I can say. What kind of a behavior are we talking about in terms of increasing customer care base and increasing credit card spends, and also the personal loan category, which is going up for banks?
See, the overall reason the credit card debt is increasing as well as overall personal loan outstandings are increasing is mainly because there is a lot of credit starved market within India. And I think I will disagree with the earlier panelist a little bit that it is not necessarily a scary trend because we can't characterize all online spending as frivolous in nature because post-COVID spending behaviors have changed per se in terms of how people spend even for necessities like essentials like groceries and everything are also being purchased. And if you are looking at credit card penetration within India, while it has increased quite a bit, and we were looking at the data which showed about 11.6 million new credit cards have been added, the overall credit card penetration is still about only 60 million people in a country of 1.4 billion people with over 700 million people in productive employment. So we are barely, in terms of the access to unsecured credit in India is very limited. And to characterize any growth in that as something that should be of great concern is something that I would at this time disagree. I mean, we should always look at trend lines to understand how and why they are why it is increasing. But it is more to do with behavioral patterns, wherein a lot of spending is moving away from offline world into the online world, and a lot of the purchases done in the online world are credit card driven purchases. Of course, UPI also has a big role to play, but people do prefer credit cards for reasons like uh, the free holiday period they get with respect to purchases. So we need to kind of make sure that we are looking it through the right lens. And the reason the personal loan growth has happened, if you look at mortgage rates in the last 12 months or so, we have seen a 250 basis point to 300 basis point increase in mortgages. So the asset purchasing of home loans and other loans, asset purchasing of homes via loans has really come down, which means that customer has more disposable income. Now, in terms of in terms of debt burden to income ratio, the customers have more availability in doing other purchases. So this may be just a characterization of using some short-term, meeting some short-term needs, whereas they are putting back their long-term asset purchases, which may get reversed in a short period of time. So this is something that we have to keep an eye on.
I was looking at some data, Ritesh. So, when we talk about inquiries for personal loan and credit card demands, the inquiry volumes in the 18 to 30 age group has crossed 40%. Okay, and we are talking about the December quarter data, and it was almost 40% or lower than that a year ago. Especially in the rural segment, we are seeing this demand going up beyond 20-25%. Now, that is something that we need to note down. But and also continuing from what Anil also was talking about, is there any data where we can understand the kind of NPAs, maybe if there are there in these particular segments that we are discussing, credit card spends or personal loans, or you think it's just the disposable income that has gone up and people are spending and using the kind of available cash they have?
Kavita, I think it's a combination of several factors. Look, we can't just attribute the reason for personal loans growth to just the last 3-4 years or a pent-up demand. Personal loans have been growing from financial year 15 to financial year 20. They have trebled, growing at a 30% year on year, right? There has been a behavioral shift in the consumers, right? I mean, and a cultural shift as well. I agree with Anil in terms of, that behavioral shift in terms of online spending on credit cards, digitization of payments, that have led to an increase on the credit card spend. At the same time, on the cultural shift that we are seeing, right, being averse to credit to kind of, being open to dip into new forms of credit for, doing aspirational purchases. So I would tend to take a middle ground in terms of, yes, we have to we're looking at this with a cautious optimism in terms of, the growth in retail lending, growth in personal loans, fueling almost over a third of the bank credit growth. At the same time, it's the Generation Z and early or late millennials who are entering this marketplace and are the biggest contributor to the growth in personal loans, right? So, and of course, as a consumption heavy economy, I mean, our 5 trillion dream of being a 5 trillion economy, which will be largely fueled by credit. So as an economy, we have to come to terms with the fact that there will be retail credit growth. It will happen. The banks or the lenders will not stop. The question is going to be looking at some key trends in terms of, as far as the NPA goes, I would say there is a fair amount of stress pre-NPA that we have started to see build up in terms of consumers over borrowing and and then failing to or struggling to make payments and going from paycheck to paycheck, which is also leading them to kind of dip into smaller ticket size loans, sometimes to just pay the EMIs and then going and looking out for new loans. So it's a combination of various factors. That's what I would attribute this to.
Exactly. But Aparna, one thing that a report that I'm going through says that personal loans have gone up almost 25.8% year on year, but then credit card outstanding has also gone up to almost 30%. Now, this is something that you were referring to, Aparna, earlier, and this is worrisome. Also, Aparna, are we talking about someone, and Ritesh clearly mentioned it's Gen Z and millennials who are really exploring. Exploring is one thing, but then are these the same kind of people who are spending through credit cards, or they also have a personal loan and a home loan, too much financial liability on them?
This is exactly what I was trying to tell you. Just the credit card spend is positive in that sense, but it is these people failing to pay that credit card dues. Like I was earlier telling, people converting those outstandings into EMIs, failing, and all of that. Now coming back to your question, in the last 3 weeks, especially where I am observing in Rectify Credit, the customer base that is coming, they are coming with issues which are almost they are all that typical 28 to 35, 37. That's the age band. And then they have in their Excel a list of companies, or online fintech companies from where they have borrowed. These are not the regular banks, these are these fintech lenders. So the rate of interest is ranging between 18 to 20 to 24%. And people are borrowing as little as some people have even come with 10,000 that they have borrowed at 24%. Now what I am worried about is if this individual could not get credit at 12% or 10%, or a personal loan got rejected, and that is where they are ready to pay this 18%, 20%. How can they sustain this repayment? It is not possible. So the defaults are only going to go up. And typically, to the second part of your question, typically the defaulter doesn't come with one default. On an average, there are three. Otherwise, we are looking at 4 to 5, and in extreme cases, more than that. But typically, an average default number of accounts that a credit report comes to us is with these three accounts where there is a default, in which invariably one or two are credit cards, and then the rest is, personal loan or auto loan or whatever, what have you.
Anil, your take on this?
See, I mean, definitely agree with Aparna on some of the points she has mentioned. See, is there some curiosity factor, like Ritesh mentioned, with respect to a lot of below 30-year-olds who are starting to explore credit and are trying to understand it? And for the first time in India's financial services history, these customers actually stand a chance of getting some credit. The point that Aparna is making in terms of a lot of these customers are probably getting a 10,000 rupee or a 20,000 rupee loan at a relatively high interest rate than what a bank would charge. Uh, that opportunity didn't exist before. That market didn't exist before. Now, a 25-year-old employee who has 2 years experience from a tier 3 town working for a small manufacturing unit actually has a shot at getting credit. And that is the change that has happened in India, that is kind of fueled by digital lending initiatives, whether it's by fintechs or banks or NBFCs, irrespective of who is doing it. What it has done is it has brought a new customer into the market. If you're, and once more, I keep going back to the earlier point I was talking about. If you're talking about credit card spend and are starting to worry about it, these are the 60 or 70 million best customers in India, the top 6 crores, 7 crores. Incomes about multiple lakhs per month with credit scores over 750. So why, that's a completely different segment, and this segment that we are talking about is the segment which is the young and upcoming segment, which for the first time in India's history have an opportunity to get such a loan, which helps them build credit. We should also see the positive of it, which is now this customer has taken a 10,000 or a 20,000 rupee loan, is able to establish repayment history which will improve their credit score, putting them in line to get a home loan or an auto loan from a bank, which they would not had the opportunity if they didn't have that credit score in the first place. So that's the other perspective on the same
As long
aspect.
as you're doing it in a healthy way, maintaining your credit score and having a disposable income and a repayment strategy, it's all fine. But then one interesting trend, Ritesh, which you might want to elaborate and help viewer understand. So the growth in loans majorly have been driven by NBFCs and fintech companies. Now, this is something that we already knew, but then this is reaching a new high in 2023 so far. How do you look at it?
So the growth of personal loans among the fintech, essentially lent by the fintech, is largely due to miniaturization of credit. I mean, if you look at conventionally banks lending, a typical average ticket size of a bank on a personal loan is upwards of 1.5 lakhs, whereas we are seeing a new trend where the average ticket size on personal loans has come down to 25,000. Now, I think above all that, the point that Anil mentioned, which was yes, we do see millennials and Gen Zs. What's the quickest form of building credit, right? I mean, is to take a loan, repay a loan, so you can build a credit worthiness, right? But there has to be very extreme caution exercised by these millennials and Gen Zs in terms of the very strategy of building a credit, right? And you taking on more loans, right? Especially these, BNPL or Care Now, Pay Later and Travel Now, Pay Later kind of loans to fulfill your near-term lifestyle needs can land you in the trouble, right? And then again, you go from, paycheck to paycheck, and you're just one bad news away from falling in the trap. So miniaturization of credit, democratization of credit, destigmatization of debt as such, right? It's a perfect storm that's kind of building together.
All right.
And
I think we'll have to just wrap up this discussion over here because